The US Federal Reserve has approved its first interest rate increase in more than 3 years to address spiraling inflation. The central bank had kept its benchmark interest rate anchored near zero since the beginning of the coronavirus pandemic. With borrowing costs now on the rise, Fed officials are warning economic growth will slow. The new move will bring the rate into a range of 0.25% to 0.5%, resulting in higher financing costs for many forms of consumer borrowing and credit. Fed Chief Jerome Powell says interest rates will be raised 6 more times this year and 3 more next year. The Bank of England has also raised rates by a similar amount for the third straight session to tame inflation. Meanwhile, the Turkish central bank kept its benchmarks steady. For more on this now, let's go to Russ Mould. He is AJ Bell Investments Director in London. Russ, many thanks for being with us today. So the committee has penciled in 6 more increases this year and potentially 3 more the next year. I mean, in your opinion, given the geopolitical situation at the moment, is this realistic?
I think from an inflation perspective, it's probably very, very necessary. With US inflation at 7.9%, the last time it reached that level in the early 1980s, interest rates were nearly 13 or 14%. So US interest rates are still very, very low, you could argue, relative to where they've been historically at this time. Equally, there's more debt in the US system. As you say, we have the geopolitical concerns in Eastern Europe and the knock-on effect of those of higher commodity prices and particularly higher fuel prices that could slow the economy down. So it is a difficult balancing act.
And it's interesting, obviously, it's interesting. I understand they have to tame inflation and they have to act now. Fed officials and other economists, though, are saying this could lead to an economic slowdown, with some even pointing at a potential recession. How worried are you about this?
I think some degree of economic slowdown was inevitable anyway. We were seeing a slowdown in 2019 when the Fed got interest rates to 2.5%. The pandemic then changed things dramatically and the economy was supercharged. But we're now seeing that fiscal stimulus not being repeated. We're now seeing higher interest rates and tighter monetary policy. So some degree of slowdown was inevitable anyway. It's just a matter of how far, and the high commodity prices are a major complication there. But if you let inflation run rampant, you'll get an economic slowdown anyway because of the damage that it does to consumers and corporations' ability and willingness to spend and invest.